Well, joining me now, CNBC contributor and Cerity Partners chief equity strategist Jim Lebenthal and Ed Yardeni, Yardeni Research President and the co-author of the book, Stock Buybacks, The True Story. It's great to have you both with us. Ed, as we say, you literally wrote the book on buybacks. What is the truth?
Well, the truth is more complicated than the politicians care to understand. Some of the buybacks, I estimate about a third of the buybacks are actually associated with employee stock compensation plans. So when they pay employees in stock, they're trying to avoid dilution. And they're not trying to increase the earnings per share. They're trying to avoid a decline in the earnings per share by doing that. Now, the legislation that I've seen, tax legislation and all that, does seem to understand that. But then the other side of it is stock buybacks are just another way of returning cash to investors, and it's a legitimate way to do it. And it certainly is an alternative to dividends, and it benefits everybody and anybody who happens to own stocks, not just the CEOs. So Buffett is right on.
What kind of tax advantages, though, does a company have for doing buybacks? That's what some of the pushback would be.
Well, I think that clearly when they pay out the dividends, then the investors have to pay tax on the dividends, and so if they buy the stocks back, and that has a positive impact on their shares, I guess there's really no there's no tax implications right up front. But that's something that the tax laws maybe need to address rather than politicians need to address with a tax increase.
Jim, you ever buy a stock because of a buyback strategy?
I don't buy it because of the buyback strategy, but Scott, I really like buybacks, okay? What it does, when it's executed properly, is it concentrates the amount of earnings that I as a shareholder retain. Now, Ed pointed out something that a lot of times these share buybacks just sop up excess shares that are given out by share-based compensation. I don't really like that. I like a company like Apple or a company like Citigroup, and this may surprise you, but both of those companies, you look at their annual reports year after year, their share counts go down. Probably doesn't surprise you with Apple. It does surprise you with Citigroup probably. But the point being is that I, as a static shareholder, am now getting a larger percentage of the earnings than I otherwise would have. So I like share buybacks.
Would you rather own a company who had a good dividend or a good buyback program?
Buybacks, because of what Ed was pointing out.
Really?
Because of what Ed was pointing out. If I get the dividends, I get taxed right then and there. If I get the share buybacks, I now have an increased share of earnings that may or may not be paid out in the near term. Maybe they're going to reinvest in the business and give me even greater dividends way out in the future. But those taxes are now pushed off. So the tax advantage that Ed points out is very much felt by me in preferring buybacks.
So, Ed, I mean, what would your response be, when you hear an investor like Jim Lebenthal say, I'd rather buy stock in a company that has a great buyback strategy rather than a dividend?
Well, I think in many ways the buyback strategy of corporations solves the problem of the double taxation of dividends. I mean, the money that you get as an investor as dividends has already been taxed at the corporate level before they were able to pay that out. It comes out of after-tax corporate profits. And then what's left is retained earnings that goes into corporate cash flow. This notion that the buybacks are at the expense of employee compensation or that it's at the expense of proper capital spending is ridiculous, because the reality is that this, particularly now in this very tight labor market, workers are certainly getting their share of the pie, and at the same time, corporate capital spending has been basically at a record high.
But I mean, the other, if we want to call it truth in all of this, since that's how your book was titled. Just because a company, Ed, buybacks its stock doesn't mean that it was done at the most advantageous time, doesn't mean that it was necessarily, quote unquote, cheap when they did it, and certainly doesn't mean that it's going to have some accelerated, route higher as a result of a buyback, does it?
Well, we don't really have, I haven't seen data where it breaks out the buybacks between companies buying back shares to increase their earnings per share versus companies buying back shares to offset employee stock compensation to avoid dilution. If we had that, I think we'd have a better handle on exactly what the buybacks really are all about. And I think we would find out that a majority of them are, in fact, related to trying to increase earnings per share as an alternative to paying out dividends as another way to pay shareholders. And then I think a substantial amount is also used for stock employee compensation.
Maybe all buybacks, Jim, last word to you, are not created equal. Maybe that's part of the moral of this story, too.
That is part of the story. So, and Ed's pointing it out, and I think this is what you're alluding to. I don't like it when there's a huge buyback program and I look at the share count on the quarterly or annual reports, and it even goes up. That just tells me is that they're sterilizing the issuance that they've been doing in share-based compensation. Also, just to the point that you and Ed were talking about, yes, sometimes companies buy back shares and then later the shares go down. But let's face it, in the grand history of time, measured over decades, a well-run company, i.e. a company that would generate cash with which to buy back shares, generally their share price goes up over long periods of time.
Yeah, there's your big list this year of the stock buyback announcements. There's been some massive ones, as you see. Chevron and Meta certainly leading the charge, and that's really when you start to get the ire of politicians, to say the least. But this is a debate that will be continued. Ed, thank you. Jim Lebenthal, our thanks to you as well.